So this is clearly a very topical issue, and rightly so, because there's a huge amount of trade. You're dealing with China and the US, who each have around $4.1 trillion of gross trade at an individual country level. So it's obviously a big driver, and I do believe that we operate in a very globalized world with global supply chains, and so the implications of any trade war are important, not just within China and the US, but also more broadly across EM, if not globally. I think this rhetoric is going to remain with us. I don't have any particularly clear view as to when it's going to end or what the end game may look like. The key question is really, what is the impact of tariffs on certain markets, and therefore what does it mean for emerging market equities in terms of the fund that I manage? And to answer that directly, specifically when I look at China, I'm far less worried about the impact of a tariff on $400 or $500 billion worth of goods. I mean, ultimately, you've got a 4.1 trillion trade economy. Tariffs of 15 to 20% on 400 billion isn't a huge delta in terms of the overall trade balance. Where it is far more relevant, however, is in terms of what it means for the currency, for the Chinese RMB. And what has happened in China over the last few years has been that the current account has moved from a very strong surplus to a smaller surplus, and it's a country which historically has seen capital outflow. So it hasn't seen that in the last couple of years, but historically there has been a tendency for onshore capital to move offshore. And I think that if the trade wars start to reduce that current account surplus further, and the economy continues to see a moderating growth rate, the tail risk is that that creates a risk of capital flight within China, which would put pressure on the RMB. So if you then start to see devaluations of the Chinese RMB, that could filter through, because obviously China is a big customer for the majority of the rest of emerging markets. And so that's one of the risk factors that I'm focused on. I think that the Chinese policymakers have many tools at their disposal in order to enable them to mitigate some of those risks, but that is the key risk factor that I focus on with respect to US trade in China. I mean, we mustn't forget that China is one of the world's, if not the world's largest holder of US dollars. Okay, so they've got significant foreign reserves. Chinese companies are incredibly innovative, and they've sought to improve their competitive position. And so I think that you combine the reserve position, the ability to use interest rates to help defend a currency, and the fact that you've got innovative companies with very strong return profiles in many industries. Though taken together, those factors can seek to mitigate the impact of this volatility and some of the currency challenges that they're faced with. It's not to say that they can completely stop the tide of economics. And so if this becomes much more challenging in terms of the rhetoric and the actual meaningful impact, then you will see some depreciation, and we have seen some depreciation of the RMB. The question of how far it goes remains open.